This is the Retirement Planning University podcast with Jordan Schwartz and Phillis Pilvinus.
Welcome back to the Retirement Planning University podcast. I'm your host, Jordan Schwartz. I'm joined here today by my co-host, Phillis Pilvinus. Phillis, I'm personally super excited about our guest today because I have a personal relationship with him, and we talk probably almost every single day about a variety of topics. He's a friend and a leader within our organization. Brad Gaines is sitting with us here right now. Brad, where are you today? What part of the country?
I'm in the home of the Kentucky Derby and Muhammad Ali.
Very nice. So Louisville, Kentucky.
That's right. Louisville.
Yep. I know. I've lived there for a long time, but when I lived in Denver, Colorado, they say Louisville, Colorado, which threw me off completely.
Really? I never heard that.
They say Louisville, and
Wow.
I got a question for you. Your little one, what are you teaching her about money and investing?
Yeah, it's funny you mentioned that because that's a quite a responsibility. You know, one of the things that we're struggling with is, these animated video games, right, where the currency's virtual.
Mm-hmm.
And they can buy homes and buy flying dragons and buy, unicorns that, have fire on them. And she just sees those monies go, and then she gets the thing. Helping her understand that there is some real value behind money going out and having to earn money to come in. And so one of the things that we're doing right now is we're playing a lot of store, right? Where there's a certain dollar amount towards a makeup piece or an eyelash mascara. And we're calculating this and we're saying, okay, how much is it? How does it work? And I'm handing her physical dollars so she doesn't see the plastic and the virtual currency scenario, and helping her understand that the money that goes out to buy things is the same money that you're going to use to buy your future. And if that future is limited, you may not have a successful future that you want because you had a lot of things that you bought before the future that now that maybe you're overweight on in terms of expenses and spending. So I'm trying to teach her the value of a dollar comes from the value of hard work. And then how do we get into a paradigm where we're rationing it out, Jordan, where it's like we've got 70% going to expenses, we've got 20% going to savings, and we've got the other 10% going to tithing and or charitable organizations.
Very cool. Do you think she's picking up on the concept of saving now equals your success in the future?
I think she's picking up on the concept that money doesn't grow on trees. So I think I'm making some headway there. But we do have allowances, right? So if we take out the garbage, it's X dollars. If we put the dog food in the bowl, it's X dollars. If we do the cleanup of the counter of the Lucky Charms that spilled over, it's a certain dollar. So I'm equating work to earning to having the dollars work for you. So we're getting there. We're no Warren Buffett yet, but we've got 3 more years until she's 10. So maybe we can get there.
Very cool.
That's great.
Well, let's jump into our topic for today. We're talking about what rate of return should I get from my money in retirement? Now, I want to say this before we jump into it, right? Because some of these are goals. These aren't guarantees. Talk with your professional, talk with your advisor before making any sort of investment decision. It's just helpful for kind of categorizing ranges.
Yeah. And Phillis, you've got, over, 3 decades of wisdom in this.
All right, call me old. No.
That's not calling you old. That's calling you wise, right? How wise are you, Phillis? So why don't you because you've been through various economic situations. So, how have you seen this landscape kind of change? And then I'll kind of, jump in with what you're thinking. But why don't you lead us off on the different rates of return expectations in this era of lifestyle journey?
So I really think in retirement, the biggest thing that we all teach people every single day that everybody's got to be aware of is losses hurt you a lot more than gains help you in retirement. Absolutely blows people away when I do that in class and show them that averages in the market, making a lot of money and losing it in a bad year hurts a lot more than making a little bit less. I'm not saying that you don't have to make money, but slow and steady wins the race in retirement. And that is so hard for people to get that concept after years and years and years of focusing on making the most on their money and saving. So in terms of return, if you're within 10 years of retirement, you want it reliable, you want it safe, blended, and the most isn't the best unless you can be guaranteed that you're going to keep it.
So if your portfolio, let's say you got 100 grand, let's say your portfolio falls by 50%, you don't have to make 50% to get back to where you were originally at. What rate of return do you need to make to get back to the original number?
You got to make 75%, right? To get back to that.
Well, if you fall by 50%, so if we have 100 grand and that 100 grand falls by half, it goes back to 50,000. That 50K needs to double. Here's the problem though. When you look at your prospectuses or your statements, what rate of return would they show you that money has over that period of time?
100%. Yeah. Getting it back. If it got back to even, you mean, right?
Well, if you average a minus 50% return with doubling your money, what's that average rate of return over those two different periods of time, Brett?
Gotcha.
Yeah, it needs to be 50% over those 2 years for the 100% to get back to where you're at.
Just to get back.
But the previous returns, Jordan, have been 5, 6, 7, nowhere near the 50 that you're going to need for both years.
That's the tricky part too, is when you look at your statement, rate of return can sometimes be misleading, because if something falls by 50 and then doubles in the next year, it doesn't show you a 0% rate of return over that period of time. It shows you what, I think like 25% or something along the lines of that. Mm-hmm. So the problem is rate of return is sometimes misleading. So that's the first thing where, to your point, Phyllis, what you're describing is for someone who's a retiree, a big loss will absolutely devastate your retirement, right? Because you can't recover from big losses earlier years in retirement planning. So maybe what we could do is kind of categorize like safe money, conservative money, moderate money, and aggressive money, right? What's a reasonable goal or thought or expectation for how we think that money's going to perform over that period of time? And then maybe once we've got that, is sprinkle on top of that onto the investment portfolio Sunday, what tools go in that particular part of each bucket. So, Brad, what would you say is a good goal? First of all, when we say safe, what does safe mean? And what kind of a rate of return do you think is just reasonable to hope for or expect in a safe environment?
Yeah, so the word safe can mean different things to many individuals. In this organization and in our philosophy, the word safe means not a 1% downside, not a 2% downside, not a chance of losing 5, 10, 15. It is 0% downside. It is absolutely goose egg. No way you can lose money in that particular vehicle. That's considered safe in our organization and our philosophy. Now, with safe, you can still achieve different types of like returns. So we look at it like a bond proxy. So those particular investments can yield anywhere between 4 to 6, even higher, depending upon the strategies. But that's the type of safe money we're looking for there, Phyllis, is to keep up with inflation in that.
That's exactly. It doesn't, if it could do 1 or 2% above inflation, but really no losses there, no matter what economic curveballs get thrown our way, we have a place that we can take it from where we're not taking out 2 for the price of 1 when shares go down. Reverse dollar cost averaging is so much different than dollar cost averaging when you're saving.
So the goal of safety really then is to keep up with or try to beat inflation by about 1 to 2 percentage points, maybe like a long-term goal, because rates have been wonky as of late, maybe between like a 4 to 7% return, depending on the interest rate environment we're in.
Absolutely. I just got to say, I worry about people retiring today with interest rates being a little bit higher at the banks. I mean, that's a good thing. People are excited about it, money markets and CDs. But how long is that going to hold up for? And what I don't want to see happen is people count on that for their safety valves. And then all of a sudden, a year or 2 from now, boom, the rates go down to where they were a couple of years ago. And now where do people put their money? Now where do they put their safe money? So we need to help them think longer term and lock in some of that safety for the long haul.
What do you put in safety typically? Because there's the traditionalist money manager that use CDs and government bonds and fixed annuities. But what tools, let's say our goal is to keep up with or outpace inflation by 1 to 2 percentage points. Cash right now is going to lose a little bit of money to inflation because of how high rates have been. What tool do we think realistically can keep up with or maybe beat inflation by a little bit in the safe money environment?
Well, evidence tells us it's the fixed indexed annuity, the vehicle that you can gravitate toward to link yourself to market upside, but also guardrail yourself against market downside. I mean, it's evidence-based since their origination in the early 2000s, that triple interest compounding inside that vehicle is going to be the gift that keeps on giving. So that is an absolutely critical component to guard against interest rate risk that you have in those other traditional methodologies of bonds and bond funds.
Yeah, so why do you like those better than bonds? How would you compare and contrast that one?
Well, the bond is fixed, right? So you're only going to get a certain number. The fixed indexed annuity allows you to get a bigger number depending upon the strategy that you're using that is still tied to the market growth of that underlying index. So why I like them is because they're going to, I'm going to say 1 to 3%, you guys, of beat the bank CD long term and the bond long term around 1 to 3%. And they also come with some different components that are important in retirement planning, like nursing home care provisions, different types of strategies that way. So they're much more predictable to do income planning from, as well as safeguard the assets, as opposed to a bond that's going to fluctuate. And you never know if you're going to hold that bond to maturity or not when stuff hits the fan, and you might have to liquidate at a lower amount. And then, Phyllis, you know this as well as I do, the bid and ask spread commission that you're going to pay on that bond liquidation could make the return even that much south. So you just have to be careful with the traditional methods as opposed to a real 100% winner when it comes to guaranteed protection and upside opportunity, and with no commissions and no fees, candidly.
Well, also, to your point, Brad, I love that. Not only are there issues with bonds, but also most people who are investors in America today are not in bonds, they're in bond mutual funds. And if we're thinking about safe, conservative, moderate, aggressive, would you categorize an investment last year that fell by over 20% safe?
Not a chance.
I wouldn't either. It's what happened with bond funds last year. So it's happening for a lot of investors in America is they're basically thinking, oh, I'm in a safe investment. You're in a safer investment in the stock market, but not all the way safe. So to me, I think the best tool that's an alternative to bonds, which is supposed to be the safety bucket, but we know in theory and practice and application, it really didn't ever work out that way. I think an index annuity is typically, from my perspective, a much better tool in that safe money environment.
Part of the portfolio, right?
Yes. Which for the safe money environment, I personally haven't found anything I like better in the safe money environment. What about conservative? What do we define conservative as? So safe, good goal, 4 to 6, 4 to 7. Primary tool would be an index annuity, maybe a fixed annuity occasionally or a CD, but typically an index annuity. What would go in the conservative environment? What's our goal for return with that typically? What do you see?
I'm looking for a good market's probably 6 to 8% in a vehicle like that. You can still expect a little bit of risk in a volatile market, but reasonable return with total liquidity in there if you need it.
Yeah, I'm in the same boat you are, Phyllis, and maybe I'm getting a little ahead of myself, but I'm looking for a little bit more non-correlated assets in that portfolio as well.
Absolutely.
Right? Those positions that zig when the market zags. You've got your agriculture, your commodities, your short-term treasuries, your preferred stocks, things that can zig and zag. I do like that 6 to 8, Phyllis. And again, I think it's important that we're talking about net of fees too here, guys, right? And we're talking about adjusted real rates of return. So those CDs that we see out there that are claiming 5.5%, well, we've got to adjust that for inflation. So you're really only getting 2.5 really when you factor that all in. So it's the non-correlated assets on the return profile, the conservative investments that allow you to get a little bit more of a chunk there, Phyllis, and not as much of a downside in some of the more moderate and aggressive portfolios. Y'all with me on that?
Yeah, and the whole idea behind that is stocks and bonds generally will move in the same direction right now. They're going to beat to the same drummer. So since we don't know what's going to happen in the short term, I don't know about you, but my crystal ball, it's been broken for a while. The way that I protect people is having things that could potentially move in different directions. Maybe commodities is going to take off, or maybe, you've got some preferred stocks, things that will be level, keep you stable no matter what economic curveballs are being thrown our way. I think there's a couple curveballs perhaps coming. What do you think?
Well, every $1 trillion of real money in America, it's about $17 trillion of debt. So historically, people are told that as the stock market rises, the bond market falls and vice versa. But what's really happening is they're both very correlated, right? Because of the economy moves oftentimes more in line with the long-term debt cycle, equities and debt, bonds typically can't do anything other than largely move in a similar direction. So what happens is, with bond funds, that strategy becomes very flawed in that economic environment because they are very, very correlated. So to your point, Brad, that's where a lot of our non-correlated assets live, kind of in that conservative, right? Like you'd said, precious metals, real estate, commodities, all those different buckets that are preferred stocks moving in different directions. To me, I think a great goal is 6 to 8%, maybe in different and lower interest rate environments, maybe 5 to 7. But also what's important to classify, safety means losing zero. To me, conservative means if in like a 2008 scenario, market falls by 50%. Realistically, that strategy probably should be about 10% or a little bit less from a risk standpoint. Right. What do we do with moderate? What goes in the moderate? What's a good goal for that?
I'm thinking moderate's about, you should be able to average 8 to 10% in a moderate type of bucket. I think that's reasonable overall. Obviously, when the market's going down, you're not going to get that, but over time.
What would you put that from a risk standpoint? What would a worst case for someone in a moderate portfolio typically be? What do you think is reasonable?
And that piece of the portfolio, that piece could go down maybe 20% in a down market. But again, moderate.
Moderate means half as much risk.
Yeah,
kind of in the middle. Like a lot of clients, when I talk to them, they'll say, "Jordan, I want to be moderate." What does that mean? I want to get some growth and protect my downside. You kind of put yourself in the middle, best of both worlds. Safe loses nothing. Risky does everything the market does. Moderate to me is kind of in the middle of that, where you should have about half the risk of the market. For those who are, stock nerds like me, your beta is probably 0.5, right? You got about half the risk of the market. Yep. You don't move as much with that. What would you put in moderate? Because there's kind of a variety of tools that would go in that typically, I think.
Yeah, I mean, for me, Phil, I'm looking at dividend income, paying stocks on that particular yield play there. Maybe looking at some dividend aristocrats or dividend kings to try to get that fixed income dividend. Now, we all know that dividends aren't guaranteed. And sometimes these companies can pause and or expire dividend payments. But, with that fixed income component comes some, pain, Jordan, in that once that stock pays that dividend, the stock shares are going to fall. So people have to get a little understanding around how that dividend income profile works, but that's going to be a much more moderate portfolio, carrying about half the risk of the S&P. So if the S&P is up, let's call it 18, we're up 9. Are y'all with me on that?
Yeah. Preferred stocks maybe in there.
To me, I've also felt like with moderate, you're taking not just dividend paying stocks, and you're taking a lot of the non-correlated assets and safe investments, and you're blending those with our riskier stock market-based investments, where that portfolio is going to have both safe and aggressive investments inside of it. But really, to me, it's more, how do you blend those assets together to create that overall kind of moderate risk profile for an investor? And you can use ETFs with these a lot, like a gold ETF or a precious metals ETF or a real estate ETF or commodities, right? You don't have to buy, and if you do buy a gold paying stock or a real estate stock, there's going to be, because of, stampede effect, high frequency traders, a lot of algorithmic trading in the markets, those are going to largely move with the market. So typically buying things that aren't as much of that profile, but are physically backed by those assets typically helps as well to add some more of that non-correlated flavor in the portfolio.
And I think another important piece that's non-correlated are, some customized options that not a lot of people have heard of before, is the structured note, right? Which is another bond-like proxy, where you're underwriting an investment vehicle to do something that, preserves principal, but that can also give you some moderate like growth on the backside. That's an interesting product to curb out some of the risk on the volatile assets on the stock positions.
Yeah, I love that a lot, Brad. And really what structured notes, to me, the easiest way to describe them is it fully allows you to customize the risk and reward objectives within a portfolio, right? You could build them off of a conservative scenario of minus 10% or of moderate minus 25%, but it allows you to bake into your worst case into those strategies with, typically you can maybe use a stop loss in an investment portfolio, or, you could try to sell things quickly. But to me, this does it for you. And it's also, I think, a much better alternative to the traditional bond fund, which just hasn't been holding up well the last few years based on interest rates.
And really, guys, I don't know if you all have seen this study before, but since 1960, the average adjustable real rate of return on bond funds has been 1.97%.
Yes.
What's the rate of inflation? So you're saying 1.9%. You're saying that's over the rate of inflation. It's just getting 2%.
Since 1960.
Does that sound like a good deal?
Not to me, it doesn't.
Not to me, it doesn't either. So aggressive is pretty simple. It's in the market, right? You have exposure to all of the risk and ups and downs of the market because risk can vary, right? You can have just blue chip stocks. You can have tech stocks. You can have startups, right? Risk has a very, very broad spectrum. But for a risk portfolio for a retiree, that's typically blue chip stocks. What do we think is a good rate of return for that?
I kind of think over time you should be able to average 10 to 12 anyway.
Seems reasonable. And that's got all the risk of the market too. So market's fallen, we're losing all of that with that part of the portfolio.
Yeah. So Jordan, you said earlier, the beta in the moderates is at a 0.5. I mean, here we're at a 1 point or over 1 point on the beta on the aggressive strategy.
Yeah, definitely. That seems very reasonable to me for sure.
So beta just means how correlated it is to the market.
So a beta of 100% correlated to the market, a beta of 0.5, half of the correlation or more of a moderate flavor. So safe, a lot of tools. One that we would typically use for clients, not always, but typically would be an index annuity, zero downside loss. Our goal would be a 4 to 7% return in that bucket. Conservative is going to be a lot of those non-correlated assets, minus 10%. Kind of a goal would be maybe 5 to 7, 6 to 8. Moderate, 8 to 10. Combining aggressive with conservative and safe to get that worst case of around 25%. And then risk would be all the risk of the market, goals at 10 to 12%. How does someone go about building and designing their portfolio? Because we tons of tools, tons of investments, lots of goals. How does someone out there start to get clarity on, okay, what should my portfolio look like? What do you think, Brad?
A couple things that we can look at here that we tend to, kind of shine the light for clients on is, have they ever, looked at their risk tolerance? What are they willing, to, sort of lose, if you will, to have a reward at the end, and have they ever really dialed that in? One of the biggest disconnects we typically see on portfolio builds, Jordan, is that what they want isn't necessarily what they've got. So one thing that we'd want to do is help them understand what their risk tolerance is, and then build the portfolio around that number to support the pillars of the other lifestyle that they need. So they go about kind of dialing in on, at their juncture in life now, knowing sliding backwards would take way longer to get it back. How can they put some guardrails in there on what that number is? Because if they want to be a moderate investor, Jordan, but the statements are telling me that they're an aggressive investor, well, then that's a red flag. And so one of the things that we want to do is to be able to compile the investment positions inside those tools so that they can get that kind of smooth security ride that they want, as opposed to the shark tooth market that they're kind of swimming around in now.
So build a balanced allocation in all the time segmented pieces, the safe, the conservative, the moderate, and the growth, to average their overall risk comfort, as long as that's appropriate for them. And sometimes we have to guide them. They think they can take on more risk than they should at this point in time, but that's part of what a great advisor does. But generally, the blending based upon time horizon and the comfort of risk.
Also, tax classification, right? You don't put safe money in a Roth, just like you probably try to have. You have RIT, Roth, more aggressive, IRAs, different varying levels of risk, taxable accounts, probably less. One tool that I think sometimes is almost like a hack against the risk versus reward paradigm is private investments, private equity, private credit, because oftentimes those can give you outsized returns relative to the risk you're taking, meaning you can potentially get a higher rate of return relative to lower risk profiles. But I love what you said, Brad. The overall portfolio should have a lot of the different buckets: safe, conservative, aggressive, moderate. But the overarching theme is it needs to be built on a client's risk tolerance, right? What's the worst case scenario that they can have, knowing that they're going to be successful for the future and to have a good retirement? So I really like that. Makes a ton of sense.
Yeah, and I think really, Jordan, the key word there is for me, I know when I'm meeting with my clients, one of the two main themes that we're talking about, and not only in our events, but in the meeting is, do you want the success of your retirement to be 100% outside of your control? Do you want to be financed 100% by the stock market for the rest of your retirement? So one of the things you want to think about is, are you 100% probability based? Or are you a blend of risk wrap where you've got some certainty, you've got some security, and then you've got some upside when the markets cooperate? And that is where the real magic will happen over time for individuals. Like Phyllis said, it's just about getting that mindset around that portfolio becoming the paycheck, as opposed to them actively working and just contributing money.
So what we're talking about right now is kind of like a metaphorical financial house, right? Your foundation is where your safe money lives. Your walls are typically where your moderate and conservative investments live. And then your roof is where the aggressive money lives. One distinction I find, and we talk about this all the time on the pod, Phil, is people have way too much money in the roof. They've got way too much aggressive money and not enough safe money. But more importantly, what a lot of people neglect to do too is put a fence around their financial planning. I would argue it doesn't matter how safe your money is. Do you have a safe plan? Do you have all the holistic planning that goes into the recipe? Taxes, that's a risk mitigation tool, right? If all your money is in IRAs and taxes go up in the future, well, if your taxes go up by 50%, well, you just lost 50% of your take-home income in the future. Doesn't mean your portfolio's value fell by that much, but you still lost.
Don't you find that that's the redheaded stepchild of planning? I mean, I meet people every day who've never heard anything from their advisors about tax planning, understanding the future tax liability. Married couples who have no idea if something happens to one of the spouses, that their tax bill in their retirement account is going to double, going to go way up.
Well, look at long-term care as a perfect example too, right? If you have no long-term care strategy and the first spouse has a long-term care event, and let's say they have to spend $600,000-$700,000 out of pocket, what plan do they have in place for that, right? That in and of itself, that is a risk tool in retirement. So to me, if you overly focus on the investment portfolio and you neglect the planning, you're probably not going to have a successful retirement. Most advisors are product first, product second, and plan third, if even there is any planning. It should be 1A and 1B, products and planning. If you don't have a plan, it doesn't matter what products you're in. Brad, have you ever met with a client before that their plan didn't change once your relationship with them started?
Correct.
It always changes, right? The only constant is change. And most people, if you don't have a plan out there, it doesn't matter how good of advice or how magical of a product that an advisor has, probably going to have a hard time retiring because you don't have a plan. You're not going to know all the potential issues you could be making with your investment portfolio.
Yeah, and I think that's a big key, Jordan, like to help everyone listening. Like, the thing to do is really take a hard look at your financial house, because you talked about that roof getting the exposure, right? And the roof, where I come from, it gets the bird poop, it gets the hail, it gets the snow, it gets the rain, it gets the wind, right? It gets a lot of the exposure. I'd be willing to bet that majority of our listeners are sitting real high on the roof, little light on the walls and the foundation that we talk about in those classes. Really look at that and see how exposed you are to those probability based investments.
Brad, what would be probably the best advice, the one piece of advice that you think that everybody listening today should hear? What would be the most important piece of advice you can share with people about retirement planning?
Stock markets go up and stock markets go down. The market giveth and the market taketh away, Phil. So it's good to have all seasons in your portfolio: winter, spring, summer, fall, because typically fall follows summer and winter follows fall every year since the beginning of time. So understand that things are going to go up, things are going to go down. It's good to have things in all seasons, things that don't go down and can only go up when some of the other things that you have going on are going down. So blended approach to support that retirement pillar system is the biggest advice and the biggest disconnect that I typically see.
Okay, we're going to do a lightning round right now, Brad. You ready? Hold
Yep.
on tight. All right. Lightning round for retirees. At what point in time should people be concerned about building that retirement plan? When should they start thinking about it? When should they start thinking that they don't know what they don't know? Perhaps.
Well, I can go as far back as 10 years, really, which is where the start should be, right? That's going to be 3 or 4 different market cycles within that 10-year time frame. And typically with the average market taking sometimes longer than 7 to 10 years to get back to where they're at, that's a fragile decade, Phyllis, that I cannot emphasize enough. That fragile decade is the most opportune time to start seeing around corners.
Hey, Phyllis, I know this is Brad's lightning round. Can I answer the question real quick? Because you where are you going with this, Jordan? Because you just asked, when should someone start planning, right? When should they start building these things into their portfolio? My answer 99 times out of 100 is yesterday.
You took my word right out of my mouth. Yep.
Most people are needing to have already started the planning process. Now, most people's investments that we meet with, they're not behind, but their planning is behind, which eventually is going to catch up to their investment portfolio. So, Brad, I love what your thinking is, right? If someone's within 10 years from retirement, the answer is yesterday because we're falling behind. Your job's easy when you're building for retirement. Build a pile of money as big as you can. But when you're generating income or retirement's knocking on the door, we have got to already have a plan in place so that when the bird poops on the house, when the hailstorm comes, when we get a freeze, whether you're in Texas or maybe let's see if Phoenix gets a freeze this year, Phyllis, when those types of things happen, we're ready for it. And all that weight on the roof doesn't collapse the house because we've got a strong foundation and strong walls.
All right. You ready?
Yes.
Okay. Do you see a lot of retirees? What would you say should be the average amount of risk that a retiree is open to taking?
Yeah, I mean, that's going to change under their current financial circumstances. It depends on what they're willing to stomach. Phyllis, I mean, I see risk capacity on paper being a lot higher than risk tolerance in the mind and in the stomach, right?
Where do they blend, though, from your perspective? Because oftentimes I see it the other way, where they're willing to take on a lot more risk than they should, and they don't really know that. So what's kind of what you see?
Yeah, I kind of see that 15% sort of, 15 to 20% sort of, risk downside profile, depending upon what they've accumulated. They've already won the game in those occasions, Phyllis. It's about how much chicken they want to play with the stock market. But that's where I'm typically landing within that 15 to 18%. Maybe I'll back it up, 15 to 18% risk worst case.
Yeah, I would absolutely agree. I don't think, it's not a matter of how much they've saved. It's if they lose too much, and 15 to 20% or 18, they can recover that in a bad market, generally speaking. But anything more than that's really difficult to recover. So let's see. You read all the time, so I've got to ask you this. What book would you most recommend for retirees out there to read or someone planning?
First is Retirement Rules by our CEO and founder, Matthew Dickin. It's the second book that he's written. And then off the company profile would be the Retirement Planning Guidebook by Wade Pfau. His last name is Pfau, first name Wade. Just an absolute gem of intelligence and a absolute monster when it comes to tactical methodologies on thinking about retirement. It is a thick one, Phyllis. I mean, it is a snooze fest, but it is fantastic.
And he's not a financial advisor, right? So that brings.
That's correct.
Yeah.
Brad, I got a question for you too. When you are working with your investments and talking with your other half, your better half, what are some ways that you keep things as positive as possible to avoid, because we know the number one reason for divorce, I think the first or second reason is money issues. How do you keep that type of stuff positive? So someone's listening right now, and what do you think someone needs to do with their spouse?
I'll answer that. Happy wife, happy life.
Yeah, there you go, right. It's a quick one, right? But Phyllis is right, and Jordan, you're right. This is something that I see a lot with my clients, especially at events. That the education events that I do, some of the decisions in my home are mine, right? Like dill pickles, like I'm choosing that one, right? Nobody gets to choose my brand of dill pickles coming into the house. The other decisions my wife, tends to make, right? And so, but there are some joint decisions, and those are myself and my wife making them. So we have a dedicated time frame We call it a money month, right? So we get together at the end of each month and we look at the money month goals. What do we need to do? How do we need to do it? Where are we at? We're constantly discussing it so that there is no, ambiguity or fog, and we see exactly what we want to see. And if we don't, then we make changes and we reset. So the biggest advice in that answer, Jordan, is dedicated time for an unbiased, open, and connected conversation around the future and around what it needs to be for the family to have the best life that they want. It's that dedicated time. Like, it's not missed. Like, it's a must. It's a non-negotiable. If I'm sick, I'm drinking, Robitussin, and we're doing it from the bed. I don't care. Like, we're not missing that meeting. And so I think it's people will respect what you inspect, so we inspect it all the time. So have a dedicated time frame which everything comes out. What went out? Why did it go out? Is that necessary? Was that necessary? Did we do X, Y, and Z? And that way it just starts to become a repetitive system. And the more you force yourself to discuss the future, the better future you will have.
Cool. Brad, thank you for coming on today. We'll have to have you back on again.
Yeah.
And
grateful to be here.
Till next time, everybody. Thank you very much. We'll see you all soon.
You've been listening to the RPU Podcast with Jordan Schwartz and Phillis Pilvinus.